Usually when we look at the whole artificial intelligence boom, we immediately look for silicon.
Right, yeah. The chips.
Exactly, the chips. We look at those multi-billion-dollar foundries or, server racks, millions of lines of code.
We get hyper-focused on the software layer, I think. We obsess over the raw processing power of the latest GPUs.
Yeah, and because of that, the whole phenomenon feels completely ethereal. Like it just exists purely in the cloud, totally detached from the physical world we actually walk around in.
Right, but then you realize that the cloud is, it's actually on the ground.
Yes. The nervous system connecting that massive artificial brain to, your phone or an autonomous car or smart glasses, it's not made of code.
No, it's made of thousands of tons of cold, hard steel.
Steel, copper, fiber optics, massive concrete foundations drilled deep into the earth.
It's the inescapable physical reality of the digital revolution. We can design the most sophisticated AI in human history, but...
What if we can't move the data?
Exactly. If you don't have the physical infrastructure to move that data from a server in Virginia to a smartphone in Tokyo in milliseconds, the entire system just falls apart.
Which is exactly why today we are tearing apart the Q2 2026 earnings call of American Tower, ticker symbol AMT.
A really fascinating quarter for them.
It really is. So, welcome to this Talk Tickers Deep Dive. Our mission today is to break down this earnings call for you, the retail investor.
Right, zero Wall Street jargon, just the actionable data.
Exactly. Because beneath the typical corporate speak, this company, which is famous for basically building cell phone towers along the highway, is quietly positioning itself as the unbypassable landlord of the global AI boom.
And it just prompted them to raise their full-year financial outlook for the second time this year.
Right. If you're an investor, this is one of those rare moments where the market narrative and the underlying math are telling two completely different stories.
American Tower is just an incredibly unique entity. They operate on a scale that is frankly hard to comprehend until you start digging into their footprint.
Hundreds of thousands of communication sites globally.
Yeah, but what makes this specific Q2 call so compelling is this profound strategic pivot happening right in front of us.
They are fundamentally altering their geographic footprint to capture this AI wave. So let's start right where the rubber meets the road, the headline numbers from the second quarter.
Let's get into the data.
I want to look at the raw numbers first, and then figure out why the market reacted the way it did. So looking at their consolidated property revenue, it grew over 5% year over year.
And we should note they always exclude a few accounting quirks to get to that number.
Yeah, I'm glad you brought that up. When they report that 5% growth, they're excluding foreign exchange impacts and something called non-cash straight-line revenue.
Right, the straight-line revenue.
I want to pause on that for a second because straight-line revenue is one of those terms that gets thrown around on earnings calls and it drives retail investors crazy. What exactly are they excluding there?
Okay, so it's a quirk of standard GAAP accounting rules. Basically, when American Tower signs a lease with a tenant, let's say Verizon, that lease might be for 10 years.
Okay, 10 years.
And it usually includes built-in rent escalation. So maybe the rent goes up, 3% every single year.
Makes sense. Inflation adjustments, basically.
Exactly. But GAAP rules say you can't just record the actual cash you collect each year. Instead, you have to add up all the rent you will collect over the entire 10 years, divide it by 10, and report that average amount every single year.
Oh, wow. So you're drawing a straight line through the revenue.
Precisely. So in the early years of the lease, you are actually reporting more revenue on your income statement than the cash you're putting in the bank.
And then in the later years, you're reporting less revenue than the cash you're actually collecting. That completely distorts reality.
It really does. It smooths out the income statement for the accountants, but it masks the actual cash flow in any given quarter. So when management points to that 5% growth, excluding straight-line revenue, they're trying to show you the actual fundamental growth of the physical cash moving through the business.
Okay, that makes a ton of sense. So looking past the accounting illusion, their organic tenant billings, which is the true lifeblood of the core leasing business, that grew by nearly 2%.
Yep. Solid, but not explosive.
Right. But the number that really jumps off the page for me is their data center property revenue. It grew by 12%.
12% is massive for real estate.
It is. This is driven by their data center arm, CoreSite. And during the call, management noted that CoreSite added more new business in this single quarter than they did in all of last year combined.
Which is just a staggering acceleration. You have to remember, physical infrastructure is historically a very slow, predictable business.
You don't usually see hockey stick growth curves with poured concrete.
Exactly. Adding a year's worth of business in a single quarter, that indicates a fundamental shift in demand. It's not just a lucky sales quarter.
We are definitely going to circle back to CoreSite and unpack that AI demand. But finishing up the headline metrics, their adjusted EBITDA earnings before interest, taxes, depreciation, and amortization, that grew by over 3%.
And then we get to the big one, the metric management spent the most time on.
Right, AFO per share. It grew by approximately 1%.
And for anyone listening, that metric, AFFO, is the absolute most important number for any retail investor looking at American Tower, or really any real estate investment trust.
Let's break that down because I think a lot of standard retail investors are trained to look at EPS, right? Earnings per share.
Right, exactly.
You pull up a stock screener, you look at the PE ratio, and you judge if a stock is cheap or expensive based on net income. But American Tower is a REIT. And from my understanding, looking at EPS for a REIT is basically useless.
Oh, it's worse than useless. It is actively misleading.
How so?
It goes back to how accounting rules treat physical assets through depreciation. Under standard rules, companies have to depreciate the value of their physical assets over a set period. They treat that loss of value as an expense on the income statement.
Which makes total sense if you're like an airline buying a jet. Every year that plane gets older, it breaks down, and eventually it's just scrap metal.
Right, you have to account for that decay. But real estate operates on an entirely different economic reality.
Because land doesn't rust.
Exactly. A prime piece of commercial real estate, or a well-positioned cell tower, does not lose its economic value over 20 years. In fact, because of zoning laws and community resistance to new towers...
The classic, not in my backyard problem.
Exactly. Because of that scarcity, these assets typically appreciate in value. The barriers to entry strengthen the asset over time, but the accounting rules still force the REIT to record a massive depreciation expense every single quarter.
So their net income looks artificially terrible. It might look like they are barely scraping by or even operating at a loss just because they're subtracting millions in depreciation that isn't actually costing them a single cent in real-world cash.
Which is why the real estate industry created FO, or funds from operations. It basically takes that artificially depressed net income and adds the depreciation charges right back in.
And American Tower uses AFFO.
Right, adjusted or attributable funds from operations. It takes FFO, strips out the straight-line rent distortions we talked about earlier, strips out routine maintenance capital expenditures, and gives you the absolute truest measure of the actual spendable cash the business generated.
So for a REIT investor, AFFO is your true north. It's your EPS. And the headline number there was that AFO per share grew by roughly 1%, which honestly sounds completely underwhelming.
1% is barely treading water.
Yeah, if I'm looking for growth, a 1% bump in cash flow isn't going to get me out of bed.
And that is exactly why you cannot just read a headline and make an investment decision. If you read the actual transcript of the call, the CEO and CFO spent a massive chunk of their prepared remarks contextualizing that 1% number.
They continually compare these raw reported numbers to what they call normalized numbers.
Yes. And the phrase they kept repeating was excluding one-time dish-related churn.
The Dish Network churn. This feels like the elephant in the room for this company right now. It's heavily distorting their present-day financials. So let's try to visualize what's actually happening here, because churn is a very sanitized corporate word.
Right. Think about the telecom industry over the last 5 to 10 years. We went through a period of massive consolidation. T-Mobile merged with Sprint.
Right.
And as a byproduct of that regulatory approval, DISH Network was essentially handed the keys to become the 4th major nationwide carrier in the U.S. So DIH embarked on this aggressive, multi-billion-dollar campaign to build a brand new 5G network from scratch.
And to do that, they signed thousands of leases with tower companies like American Tower to place their antennas on those physical structures.
Exactly. But building a nationwide cellular network from scratch is brutally expensive, and Datish has faced severe capital constraints and strategic shifts lately. So now they're optimizing.
They're cutting costs.
Yeah, they're looking at their network map, finding redundancies, and terminating leases where they don't absolutely need the coverage.
So let's use a real estate analogy here to make it plain language for everyone listening. Imagine you own a highly sought-after commercial apartment building. Verizon and AT&T rent the luxury penthouses, and they pay their rent like clockwork.
Okay, I'm with you.
A few years ago, DSH comes along and signs a lease for the entire basement level. You spend money outfitting that basement for them, and they start paying a substantial amount of monthly rent.
Right.
But then halfway through the lease, DSH runs into financial trouble. They break the lease early. As the landlord, you take an immediate painful hit. You lose that monthly rent revenue.
And you probably have to spend money physically removing their custom equipment, cleaning up the space.
Exactly. So for that specific year, your total rental income drops significantly. If an outside observer just looks at your top-line revenue, they'd assume your building is losing its appeal. They'd think the neighborhood is going downhill.
But that outside observer is missing the underlying reality. Verizon and AT&T are still up in the penthouses, and they just agreed to a 3% rent increase. You actually have a line of wealthy tenants out the door wanting to rent space.
Yes, the underlying demand is booming. The drop in revenue is entirely due to one specific subtenant breaking a lease, a one-time event that leaves you with an empty basement that you can now turn around and lease to an even wealthier tenant, like an AI cloud provider.
That is the crucial distinction management is communicating. The DSH network churn is a finite, calculable event. It is a hole in the bucket that is currently draining out their top-line growth. It creates a massive structural drag on the books for 2026.
So when we apply that normalized lens, when we look at the health of the apartment building without the anomaly of the broken basement lease, the numbers look completely different.
Radically different.
Normalized for the DSH churn, their property revenue didn't grow 5%. It grew over 7%. Their organic tenant billings didn't grow 2%. They grew over 4%.
And most importantly, that crucial AFO per share didn't grow a meager 1%. It grew over 5% on a foreign exchange neutral basis.
5% AFO growth is a totally different story. It fundamentally alters the investment thesis. Because if you are buying a stock, you're buying its future cash flows. You have to ask yourself, are you pricing the company based on a one-time restructuring event by a single tenant? Or are you pricing it based on the underlying recurring cash flow engine?
And the normalized data clearly proves that the core business of leasing tower space to the dominant carriers is incredibly robust.
Which brings us to the next logical question. If the underlying engine is running at 5 to 7% growth, despite the DSH anchor, what is actually fueling that engine? Let's dive into the story behind the numbers.
Management laid out a very clear, multi-layered thesis for this. They identified 4 major catalysts driving forced network investment well into the 2030s.
Okay, let's take these one by one. Catalyst number 1 is what they're calling the 5G capacity phase. Now, I want to push back on this immediately. If I look at the top right corner of my phone right now, it says 5G. I've had a 5G phone for years.
Right, we all do.
Every major carrier runs commercials boasting about their nationwide 5G coverage, showing the whole U.S. map painted blue or magenta. If the map is already covered, what is possibly left for AT&T or Verizon to spend billions of dollars on? Why do they need to lease more space?
It is the difference between coverage and capacity. When a new generation of wireless tech launches 3G, 4G, or 5G carriers prioritize coverage first, they just want to light up the map for the marketing win.
To say, we have 5G in your town.
Exactly. And to achieve that, they utilize lower frequency spectrum bands. Lower frequencies have incredibly long wavelength. They can travel for miles from a single tower, and they easily penetrate buildings and trees.
So in the coverage phase, you don't really need more towers. You just upgrade the equipment on the towers you already leased to broadcast that low-frequency signal as far as possible.
But there is a brutal trade-off in wireless physics. The lower the frequency, the further it travels, but the less data it can actually carry. Think of it like a one-lane country road.
Okay.
It goes on forever, but if you try to push 1,000 cars down it at the same time, you get a massive traffic jam. Coverage does not equal quality.
Oh, I felt this. Your phone says 5G, but if you go to a crowded stadium or a downtown area during rush hour, your data speeds crawl to a halt.
Because everyone is trying to use that same one-lane country road at the same time. So now we enter the capacity phase. To actually deliver multi-gigabit speeds, carriers have to use higher frequency spectrum bands. These act like 10-lane superhighways for data.
But the trade-off is that higher frequencies cannot travel very far, right?
Right. A high-frequency signal might only travel a few thousand feet. and it gets blocked by foliage or the modern energy-efficient glass in office buildings. So how do you provide a high-speed capacity to an entire city? You physically need to build a denser network. You need equipment on more towers closer together.
Densification.
Densification. It's the magic word for American Tower. Carriers are forced to sign new leases on additional sites or add heavier antennas to existing towers. It's pure recurring revenue.
Which seamlessly connects to catalyst number 2, new spectrum. During the call, management noted there's roughly 800 megahertz of new mobile spectrum coming in the U.S. over the next few years, starting with something called the Upper C Block around 2027.
We talk about spectrum a lot in telecom, but it can be abstract.
Okay.
I like to think of spectrum as invisible real estate.
Invisible real estate, I like that. It's the literal airspace, the radio frequencies that data travels on, a finite resource controlled by the government.
And the FCC auctions off different blocks to the carriers for billions of dollars. This C-band spectrum they're talking about is widely considered the Goldilocks zone for 5G. It's mid-band, it travels reasonably far, but carries a massive amount of data.
But here's the critical mechanism for investors to understand. Owning the invisible real estate is completely useless unless you have the physical equipment to broadcast on those specific frequencies. If Verizon spends $10 billion buying spectrum, they can't just flip a software switch to start using it.
No, because radio antennas are precisely engineered physical hardware designed to resonate at specific frequencies. An antenna built for low-band spectrum literally cannot broadcast mid-band spectrum. It physically won't work.
Therefore, every single time a new spectrum cycle begins, every time the FCC auctions off a new block, it translates directly into physical installations on the towers. The carriers literally have to hire crews to climb the towers, install new heavy radio units, run new fiber optic cables up the pole.
And American Tower charges them for the extra weight, the extra space on the ground, and the extra wind load the new equipment creates. It's a highly predictable growth engine.
And that dynamic only accelerates when we look at catalyst number 3, the 6G transition. It feels wildly premature to talk about 6G when we're still figuring out 5G, but infrastructure planning operates on decade-long timelines.
Management is already looking at the 6G horizon, and early indications show 6G will leverage even higher frequency spectrum, moving into millimeter wave and sub-terahertz ranges.
If we follow the physics we just discussed, the implications of moving to sub-terahertz are wild. Those signals carry an unfathomable amount of data, but they might only travel a few hundred feet. They're essentially line of sight. If a truck drives between your phone and the antenna, you could lose the signal.
The atmospheric absorption is severe. Oxygen molecules literally absorb the radio waves at those frequencies. So if 6G is going to deliver, say, immersive holographic video or sub-millisecond industrial automation, the traditional macro cell tower, Model 1 tower covering 2-mile radius is no longer sufficient.
You'd need a transmission site on practically every city block, a level of site density that makes today's network look primitive. And who owns the most strategic, highly permitted, structurally sound real estate to host those thousands of new nodes?
The incumbent tower companies. It creates an almost unassailable economic moat. Permitting a new cell tower in a densely populated area is notoriously difficult. Zoning meetings, environmental studies, local opposition, it takes years. American Tower already has the permitted steel in the air.
Okay, so those first 3 catalysts, 5G capacity, new spectrum, 6G, they make total sense. But they're also the standard telecommunications playbook. We saw this in 3G and 4G. Catalyst number 4, though, is where we get to the core premise of this deep dive. Catalyst number 4 is AI applications.
This is the truly structural shift. This is the catalyst that has the potential to fundamentally reshape network architecture from the ground up.
During the call, management highlighted a statistic that completely upends how we think about the internet. They noted that because of AI applications, uplink traffic is growing 50% faster than downlink traffic. We need to spend some time here because this asymmetry is the key to their entire strategic pivot.
Let's look at the history of the internet. For 30 years, it's been entirely asymmetrical. We are fundamentally consumers. We download software, we stream 4K movies from Netflix, we pull high-res photos down from Instagram.
We were a society of digital receivers. Sure, you might upload a TikTok video or send an email attachment, but historically 99% of consumer data was pulling data from the cloud down to the device.
And because of that, the entire physical architecture of the internet was built around downstream consumption. The fiber optics, the routers, the cell antennas, they were physically configured to have massive downlink pipes and comparatively tiny, highly constrained uplink pipes.
But Edge AI flips that dynamic entirely on its head. Think about a level 4 autonomous vehicle driving through downtown Chicago. That car is not downloading movies. It's equipped with high-def cameras, LiDAR sensors, radar. It is constantly generating gigabytes of environmental data every single minute.
And it needs to send that data up to the cloud for real-time processing and AI inferencing.
Or consider smart glasses. If you're wearing a device that uses AI to analyze the world around you in real-time translating signs, identifying objects, those glasses have to stream a persistent, high-definition video feed up to the AI model.
We are no longer just receivers. Our devices are massive data generators. The edge of the network is suddenly screaming data back toward the core. And today's cellular networks simply were not engineered for this kind of persistent, bidirectional heavy lifting.
The tiny uplink pipes are going to choke.
Exactly. As AI scales, telecom operators are going to be forced to invest capital far beyond their historical roadmaps just to prevent their networks from collapsing under the weight of this upload traffic.
Which brings us to the most brilliant and perhaps most misunderstood asset in American Tower's portfolio. Back in 2021, they acquired a data center operator called CoreSite. At the time, a lot of analysts scratched their heads. Why is a cell tower company buying data centers? But looking at this uplink explosion, it looks incredibly prescient.
Let's look at the numbers for CoreSite because they are astonishing. They announced that 9 of the top 10 AI companies and 3 of the top 5 neoclouds are currently deployed within their CoreSite facilities.
We should quickly define neocloud because that's a very specific industry term. When we say cloud, most people think of Amazon Web Services, Microsoft Azure, Google Cloud, the traditional behemoths.
Right. Neoclouds are a newer breed, companies like CoreWeave or Lambda Labs. Instead of focusing on traditional enterprise IT workloads, they are purpose-built from the ground up, for one thing. High-performance GPU computing.
They stockpile tens of thousands of specialized AI chips like NVIDIA H100s and rent out access to that bare metal compute power for training massive language models.
And these neoclouds, along with the foundational AI companies, are setting up shop inside CoreSite's data centers. But here is the thing. CoreSite isn't just a digital storage locker. These companies aren't just renting a cold room to rack servers. They are establishing what management calls private on-ramps.
This is where the true value lies. It's about interconnection.
Yeah.
But I want to play devil's advocate here for the listeners.
Okay, go ahead.
If AI is ultimately just software, just algorithms and compute power, why does it physically require specific, highly interconnected data centers?
No.
Why can't these AI companies just build a massive server farm in the middle of the desert where land and electricity are cheap, connect to the public internet, and serve their models using standard fiber?
It is the multi-billion-dollar question, and the answer comes down to 2 inescapable constraints of physics and network engineering: latency and data gravity.
Let's tackle latency first.
Latency is the time it takes for a packet of data to travel from its source to its destination and back again. Even though data travels through fiber optics at roughly the speed of light in glass, distance still matters.
Right.
If you build your AI server farm in the Nevada desert and a user in New York queries that AI, the data has to travel across thousands of miles of public internet architecture. It bounces through dozens of different routers and peering exchanges owned by various telecom companies.
Every single time that data hits a router, it has to be processed, routed, and sent on its way. Each hop adds milliseconds of delay. And on the public internet, you are sharing that pathway with everyone else. You're in the same digital traffic jam as someone downloading a video game.
For a web search, a delay of 50 milliseconds is imperceptible. But for AI inferencing, latency is the enemy. Let's go back to the autonomous vehicle. If that car's camera sees a pedestrian step into the crosswalk, it needs the AI model to recognize the hazard and send the command to hit the brakes in single-digit milliseconds.
You cannot send that video feed over the congested public internet to a server in Nevada and wait for the response. The delay would literally be fatal.
Exactly. So you have to bring the processing power physically closer to the end user. You need edge computing. You need the AI models residing in data centers located in dense urban hubs, physically adjacent to the telecom networks gathering the data.
And that brings us to the second constraint, data gravity. It's the sheer volume of data required to operate these models is so massive that moving it across the public internet is incredibly expensive, insecure, and painfully slow.
And this is where CoreSite's on-ramps solve the problem. Their facilities act as physical interconnection hubs. Imagine a massive, highly secure building in downtown Los Angeles. Inside that building, you have the network routing equipment for AT&T, Verizon, and T-Mobile.
Okay.
In the same building, you have the servers for AWS and Microsoft. And in the same building, you have the GPU clusters for the neoclouds. Because they are all physically located in the exact same facility, they don't have to send data out onto the public internet to communicate.
They can literally run a cross-connect, a physical dedicated fiber optic cable across the room to connect directly into each other's networks.
That dedicated cable is the on-ramp. It completely bypasses the chaos of the public internet. It allows for the secure, instantaneous transfer of terabytes of data. It's the digital equivalent of building your factory right next door to your primary supplier and running a private conveyor belt between the two buildings.
Instead of loading materials onto trucks and fighting traffic on the public highway, that makes perfect sense. And as AI inferencing scales from experimental chatbots to mission-critical enterprise applications, that physical proximity becomes the most valuable real estate in the digital world.
CoreSite's position at the physical center of these ecosystems is an economic moat that is incredibly difficult to replicate. You can build a new data center, but you cannot easily replicate the dense ecosystem of networks they've curated over decades.
And American Tower is leaning into this reality aggressively, which brings us to a massive strategic shift they executed this quarter. In June, they finalized the sale of their tower operations in the Philippines and Bangladesh. They have officially and completely exited the Asia-Pacific region.
This is a highly deliberate capital rotation. To understand why it's so significant, you have to look at the macroeconomic reality of operating infrastructure in emerging markets versus developed markets.
When an investor hears a global company is exiting an emerging market, the immediate assumption is that growth is stalled. But the reality is mobile data usage in places like India, Bangladesh, and the Philippines is exploding. The population density is massive. The demand for cell towers is there. So why walk away?
Because demand for the asset does not always translate into high-quality, predictable cash flows. Operating cell towers in emerging markets carries operational and macroeconomic risk that simply doesn't exist in the US or Europe. Let's look at the operations. In rural Bangladesh, the electrical grid is highly unstable. You cannot rely on continuous commercial power.
Which means the tower operator has to supply the power.
Exactly. You are forced to install massive diesel generators at thousands of remote cell sites. You have to constantly dispatch trucks to refuel those generators. You deal with diesel theft, equipment vandalism, maintenance in harsh environments. You aren't just a passive real estate landlord anymore. You are actively managing a complex, decentralized energy grid.
And that operational complexity eats directly into your profit margins. But beyond the physical challenges, there is the macroeconomic risk. These are multi-decade assets operating in environments with complex regulatory regimes and, crucially, severe currency volatility.
American Tower is a U.S.-based company. They report earnings in U.S. dollars, pay dividends in U.S. dollars, but the revenue in the Philippines is in pesos, and in Bangladesh, it's taka.
So even if your local tower business is performing perfectly, signing new leases, increasing rent locally, if the local currency depreciates severely against the US dollar, all of those gains are wiped out when you translate those earnings back home.
You're taking on massive foreign exchange risk for a yield that might not justify the headache. So management looked at this objectively. They looked at the friction in emerging markets, and then they looked at the once-in-a-generation bloom in U.S. AI data centers.
And the steady growth of their tower programs in Europe, where the power grids are stable and currencies are reliable.
Right. And they made a ruthless, pragmatic choice. They're cashing out their ships at the high-stakes emerging market table and pushing all that capital onto the steady, high-yield table of U.S. AI infrastructure and European telecom. It's a prioritization of the quality of their earnings over the sheer global scale of their footprint.
All right, so we've covered the headline numbers, the AI and spectrum drivers, and the pivot out of Asia. Now, I want to look forward. What did management say about the future? Because they raised their guidance across the board for the rest of 2026.
And from a market psychology perspective, raising guidance halfway through the year in an uncertain economic environment is a massive signal of confidence.
Let's fire off the new outlook data. Property revenue outlook raised by $110 million, which implies a solid 6% normalized growth rate. They aggressively raised data center growth from 13 to 15%, adjusted EBITDA raised by $45 million, and AFFO per share raised by 9 cents.
But we can't just take the top-line revision at face value. There's a complex tug-of-war happening beneath those numbers. We have to look at the specific tailwinds pushing them higher and the headwinds dragging them down.
Let's start with tailwinds. Management identified $35 million in foreign exchange benefits.
This is the inverse of the risk we just discussed. Because they still operate heavily in Latin America and Europe, if the US dollar weakens slightly against the euro or the real, the revenue earned there suddenly translates into more US dollars on the earnings report.
It's an optical benefit, but a real benefit to the balance sheet. They also noted $25 million in operational outperformance from the data center division, proving that AI on-ramp demand is translating into hard cash faster than modeled.
But the headwinds are equally significant. First, there's the lingering impact of the Dish network churn. Management quantified it clearly. Dish is creating a 400 basis point drag on their US and Canada growth rate.
And for those listening, 400 basis points just means 4%. Digi's anchoring their domestic growth by a full 4%. That is a massive weight.
And then there is the macroeconomic elephant in the room, Jalris rates. Management noted the higher interest rate environment is creating a 150 basis point headwind, a 1.5% drag to their AFO per share growth, up from the 100 basis point headwind projected earlier.
Why does a cell tower company care so much about interest rates? As a REIT, they are legally required to pay out almost all taxable income as dividends.
Right, to avoid corporate income tax.
Right.
But because they pay out all their cash, they have zero retained earnings to fund growth. If they want to build a new tower or expand a data center, they have to continually access the capital markets. They have to borrow money.
American Tower currently has a leverage ratio of roughly 4.9 times their EBITDA. Management says that's within their target range. But regardless, when you carry billions in debt, the cost of servicing it impacts cash flow.
And we are living through a regime change in the cost of capital. For the entire 2010s, companies borrowed billions at historically low rates, 2-3%. But debt matures. If a bond issued in 2021 matures this year, you have to pay the principal back.
And to pay it back, you usually have to issue a new bond. You refinance. But you aren't borrowing at 2% anymore. You're refinancing at 5, 6, or 7%. That incremental increase in interest expense eats directly into your AFFO. Every extra dollar paid in interest is a dollar you cannot distribute to shareholders.
Even though they aggressively manage their floating rate debt exposure, higher refinancing rates are a structural headwind.
And finally, their services business site acquisition and permitting is stepping down, creating another 100 basis point headwind. So my metaphor here is a runner entering a marathon wearing a heavily weighted vest. You have a 4% DS8 weight on your chest, a 1.5% interest rate weight on your back, and a 1% services weight on your shoulders.
Management was very transparent about this. In fact, the CFO explicitly stated that 2026 represents the trough year for AFO per share growth.
A trough implies this is the absolute bottom, the darkest before the dawn. They are explicitly promising a meaningful inflection in 2027, a return to mid to high single-digit growth once these headwinds abate. But as an analyst, I have to push you on this. Are we sure they aren't just putting lipstick on a pig? When they take this weighted vest off next year, is that meaningful inflection realistic, or is this just corporate hope?
If we strip away the rhetoric and look purely at the mechanics, the 2027 inflection is highly credible. The reason lies in the nature of those weights. They are finite. The DISOS churn has a defined endpoint. Once that equipment is gone and the lease is terminated, the year-over-year comparative drag vanishes. When you calculate growth from 2026 to 2027, you are starting from a clean foundation.
The storm damage is cleared, the basement is empty.
Precisely. And regarding interest rates, the consensus view is we are near the peak of the cycle. Once their debt is repriced at current market rates, the incremental year-over-year headwind diminishes significantly. The weights truly are temporary.
But removing weights doesn't magically make a tired runner sprint faster. You still need a strong underlying engine generating new revenue.
And to verify that, you just follow the money. Where is management deploying capital? They outlined a $1.9 billion internal capital expenditure plan for the year. $700 million is going straight into developing new data center capacity, $370 million into constructing new, highly profitable towers in stable European markets.
They aren't hoarding cash or buying legacy assets. They're pouring concrete and racking cooling systems today for the AI demand in 2027. They have a fully funded pipeline to nearly triple CoreSite's capacity.
So because the headwinds are temporary and the tailwinds are systemic, that 2027 narrative holds up very well.
Which brings us perfectly to the final phase, the bottom line. We've thrown a lot of theory, physics, and accounting at you today. But for you, the retail investor listening right now, what is the verdict?
Our stance is solidly bullish for the long term. There is a specific window of opportunity right now precisely because the market is distracted by short-term optical noise.
Actionable takeaway number 1, the AI backdoor play. If you want to buy NVIDIA or Microsoft to play the AI boom, you're paying massive premiums.
30, 40 times forward earnings.
But the market is remarkably inefficient with hybrid assets. ETFs and screeners still classify American Tower as a boring cell tower landlord. An analyst on the call actually pointed out that CoreSite isn't getting full credit from the market.
That structural mispricing is an inefficiency you can exploit. This stock offers a backdoor entry into unbypassable AI infrastructure at a reasonable REIT valuation.
You're buying the picks and shovels of the AI gold rush at a discount. Actionable takeaway number 2. Look past the trough. The market is short-sighted. Algorithms see 1% AFO growth and trigger a sell order.
But you are not an algorithm. If you are a long-term holder, the normalized numbers prove the core business is incredibly healthy. You buy during the optical trough before the broader market recognizes the 2027 inflection.
And actionable takeaway number 3, the dividend floor. A concern with wait-and-see plays is the opportunity cost. But because this is a REIT, you are paid to wait. They are returning $3.3 billion directly to shareholders this year.
The revenue isn't reliant on consumer spending. It's generated by decades-long leases with massive telecom monopolies. The dividend is as secure as practically anything in the equity markets.
Synthesizing all of this, the true brilliance of their current strategy is their ruthless focus on the quality of their earnings. By exiting riskier Asian markets and aggressively rotating into US AI data centers and European towers, they are drastically lowering the company's risk profile while increasing exposure to the highest growth tech trend of the decade.
It's a masterclass in capital allocation, really.
It absolutely is. So, to wrap this up, the optical trough of 2026 is masking the engine that will drive 2027. But before we let you go, I want to leave you with one final provocative thought. During the Q&A, an analyst brought up satellite internet. We hear constantly about SpaceX, Starlink. The narrative is that space-based networks will bypass cell towers entirely, beaming internet straight to our phones.
Right. It's a very common bearish thesis.
But management casually dismantled it. Satellite internet is complementary, not a replacement, due to the inescapable physics of signal propagation.
Beaming a signal through miles of atmosphere causes massive degradation, and satellites moving thousands of miles an hour can't deliver the consistent ultra-low latency needed for dense cities or real-time AI.
Physics dictates that to offer reliable mobile broadband, satellite providers inevitably have to deploy terrestrial infrastructure. They have to build massive ground stations to catch the signal and inject it into the fiber network.
They need physical edge computing facilities located near those gateways.
Exactly. Even companies trying to bypass the Earth entirely eventually have to come back down to the ground. And when they do, they need secure real estate, massive power connections, direct fiber. The most efficient path is to partner with incumbent landowners like American Tower.
The technological frontier keeps expanding outward, but the physical requirements of connecting those frontiers remain stubbornly terrestrial.
So, as AI compute moves to the edge, and satellite networks collide with the need for ground receivers, could it be that these seemingly boring legacy steel cell towers are actually destined to become the single most vital, unbypassable physical choke points of the entire 21st century digital economy? Something for you to keep an eye on.
It fundamentally changes how you look at the physical world around you.
That is all for this Talk Tickers Deep Dive. Thank you for joining us as we unpack the physical reality behind the cloud. Keep looking past the headlines, follow the cash flow, and we'll see you next time.